energy was a star. So let me actually get the actual numbers and so I'm not just going off my horrible old dad memory. But yeah, the revenues were up. It was like 87%, I think, quarter over quarter. Scroll over here.
Yeah, it was like a double, right? It wasn't like 100% year over year.
Yeah, roughly. So the deployments were up about 136% at quarter over quarter was the figure I was looking at. I think the revenues were up 87% quarter over quarter. Year over year is the bigger jump. And then the energy gross margin, this is the thing that a little bit more important, just in the middle of updating my whole model here. So it's a little bit messy. Yeah, so the gross profit.
Larry Goldberg a call right now and get those numbers faster.
I thought Xander was going to be talking about the stock price. I thought I was done.
While you work on that,
I've actually got it. Okay. So it was 400 million in Q1, the gross margin on energy, and that jumped to 740. So nearly a doubling, not quite.
Gotcha. And then as a component of the business in terms of the top line, it's what, 12, 13% of revenue?
That sounds about right. I'm not going to take 2 minutes and do the math.
No, but roughly.
And profit.
Roughly that, but in an outsized portion of the gross margin, because the gross margins are higher than the auto side of the business. And importantly,
they're
growing
at
way faster than auto.
24.6. Exactly. They're
Gotcha.
24.6 for energy, and they were, 14.7 if you look at it the most negative way for cars. It's not really 14.6 because you have to reintegrate those layoff numbers and whatever. But there is a significant difference between the car gross margin and the energy gross margin. And the energy gross margin, it's just also getting so stable, right? It's that is, I think, the best surprise. Other than there's actually so much more waiting for it, and I think Matt will explain that to us once he has his spreadsheets rolled it out.
I think this is like the most important part of the news story that we're looking at. As Elon stated with the new chapter, and it's not even a new chapter, it's a new book, a options market was pricing in about a plus or minus 9% move. So in this case, it's a miss, it's a Wall Street miss, and they acted accordingly. I thought that once the Wall Street type understood that like the energy growth is coming, that is how I was explaining the move from 180 to 270. So to have it stabilize here and bounce does make sense. But me personally, I posted about this. I'm kind of worried about macro to see, because I think Tesla will get dragged down, back down. That's one of the questions I want to ask all of you. I don't know if we want to do that right now, Herbert, but I really want to know what you guys think about the macro with yields and uninverting and the rotation into small caps, and how that seems to be playing out with, obviously, the volatility index has really spiked and we're seeing a lot of wild swings. Not all at once. Not all at once. I know it's exciting topic.
I can start again, but I feel I'm talking all day today, but it's okay. I think we have now, the market is 100% aligned in having the first rate cut in September. I don't think that is going to be a major driver for the market anymore. That seems to be priced in. Could be earlier, could be later, who knows? But at the moment, that seems to be the general provision. I just want to point out that we are entering a period with reduced rates, and so that is going to be fundamentally much better for the core business of Tesla, meaning selling cars is much easier with low interest rates. So that's something people should remember. The second point is that the whole economic and political environment will obviously depend a lot on the elections in November. So we're now end of July. We're still having 3 months of uncertainty politically, and I think it's going to be quite a brutal period now, right? Just we have now a new Democratic candidate has to be confirmed in August, and then I think the last 2 months of the campaign are going to be very brutal and will have a certain impact on institutional investors who may just want to go into all cash and sit it out until after the elections. So my whole outlook for the Tesla shares is rather sideways until October. I think the robotaxi event will bring a lot of things. Now, do remember, there are a lot of things happening in October. We'll have beginning of October, the delivery numbers. We should have by middle of October that 204 filing in Delaware. We also have some old court cases who are going to open again end of September, beginning of October in Delaware. So we're not done with Delaware yet. There's a couple of our old stuff still around. We may have the judgment in the Tonetta case. Then we'll have on October 10th the Robotaxi Day, on October 18th, so 20th, somewhere around there, the earnings for a third quarter. So there is a lot of stuff happening in October, and then on November 5th, the elections. So it could very well be sideways until we're behind the elections. That's what I'm trying to say, because there's just so much happening and so much uncertainty.
And I'll just try to share my thought on that broadly too. So I'm pretty concerned about consumer spending. We had a really strong GDP print today, which I was actually a bit surprised by. It seemed that a lot of the indications were that the economy might be slowing down a little bit, but the economy just seems to be like crushing it. I think the problem is consumer spending is more or less tapped out. And that being such a big driver in the economy, that is something that I'm concerned about. So I think any kind of large consumer discretionary company have a bit of risk. Tesla certainly among those. With Tesla in particular, I think that kind of risk coupled with near-term potentially another soft-ish Q3, I think that could certainly weigh on the stock for a while. But that's also, I think, offset a little bit, or at least the way that I'm thinking about it is, with as fast as FSD is moving, that might just become a mainstream opinion that they've solved it pretty soon. And if that happens, then that can be a kind of revaluation type of event. That's definitely not investment advice, and I'm not positioning our clients to take advantage of any short-term swing on a revaluation. But I think where I'm thinking about things, I'd like to be long-term invested for Tesla now, even if we do end up dropping another $50 or something like that. And then just on your point on small caps and kind of sector rotation, we do invest in a couple of small cap companies. And I think you were in the situation back during the COVID peaks where the valuation just made no sense on the upside. And I think for a lot of these companies, like the pendulum swung way too far in the other direction where, like some companies that have really strong growth prospects that we like are trading at like PEs of 10. Other companies are trading at just like fractions of where we think they should be trading. There's probably a lot of losers mixed in with the winners and small caps in general, and maybe the market's taking some time to sort out which ones might get disrupted by AI and some of the other changes that are going on in the economy. But my point of view is small caps probably deserve to get more love than they had, given that the Mag 6 made up almost all of the returns in the market in the past 2 years or so.
Yeah, I think I'll just add a couple of quick points back on the Tesla earnings. If everybody wants to put a headline out, get a tweet out under 100 some characters and move on. And if you look into the gross margin side of it, the 180 basis points, when Tesla made a decision about how they want to run their supply chain from Q1 to Q2, they had the stranded inventory from Q1. We told you about it. A lot of people didn't believe it, but it was true. Then they flushed it. They made a decision. They could have built more, and they could have kept production steady or higher than Q1 and just kept the inventory. That's what Ford's doing. That's what Stellantis is doing. That's why they're over 90 days right now in inventory. But what Tesla did is they said, no, we are an efficient company. We want low network latency. We want low assets on the books as it relates to these variable assets. So they burned off that inventory. And when you do that, it's all interconnected. They took their production down meaningfully, which took down the utilization rate. So now you're taking all these fixed costs that are still there. The factories don't go away. And then you're dividing on top of it. Now, Tesla did make moves to deprecate labor assets in the factory as well. That was part of the reductions. And I'm assuming they deprecated some capital and they did that as well, as they're going to retool and get ready for these new vehicles. But they didn't take credit for that. They didn't make that a one-time item and put it to the side. They brought it into the gross margin equation. So if I were to point to a couple of things on gross margins, one is they made a decision to take their volumes down. They're going back up in Q3. They told us that. They're going back up in Q4. Okay, so put that to the side. Because if you're running a COGS reduction program and you're not building enough new units, you're not going to see those COGS reductions in the way you'd want to see them in the quarter, because you're just burning the inventory you built from the prior quarter. So that's one. Two, they tripled the output rate of the Cybertruck and they doubled shipments. So what does that mean? Your production's always ahead of your deliveries. And when you take that big of a move in terms of production, they still haven't solved all the cost and yield challenges to build the Cybertruck. They told you that it's not going to get the break even till the end of the year. So picture in your mind, December 31st, first quarter of next year, basically, is when they're building Cybertrucks, where every Cybertruck that comes off the line is actually accretive to Tesla. Everything before that is a net drag. It's a burn. So that's going to hit the gross margins. You put it on a number. What if it's $10,000 for Cybertruck right now that they're losing, times the 11,000 ship, but more importantly, times the new build output, which is up at, I think, 1,500 a week now. That's the second point. And then the third point is they told you S3, XY COGS are lower. So net of Cybertruck that they're able to take their COGS down. But again, when you have that overlay of not building the volume and flushing the inventory, you're not going to see that, and your fixed costs are going to be too high. So what am I saying? I didn't see anything structurally that in there that shows me that the breadwinners for Tesla, the 3 and the Y, like they don't know how to build them profitably. In fact, they took their costs down. Now, the third thing, and the thing that looks like they took a more aggressive approach to how they're reflecting this financing. Okay. So they're being more aggressive there, but then they have all these credits coming in. I don't have a problem with their approach, but I think the issues are explainable and they're not necessarily structural. Finally, Tesla has entered into this quote unquote mini auto problem recession. You saw what happened with GM earnings. You saw what happened with Ford earnings. You saw what happened with Stellantis earnings. They're not good. And Tesla saw that sooner because they have lower network latency. So they're seeing these things much sooner. They don't have a bunch of product and inventory built at old pricing, old costs, sitting around in inventory. They're seeing the issues sooner. They don't have a dealer network that's buffering. They see it sooner. They react sooner. They did their internal reductions. And then when they go out with these new COGS reductions, they have 18 days of inventory. They're burning through this basically in a couple of weeks. Half of that's in transit. So Tesla's put themselves in a good position to both enter and come out of this auto slowdown faster than anyone else. I'm not saying the coast is clear and everything's great in Q3 and Q4. What I am saying is it seems like the causes from Q2, the one cause about lower production, they're going to get rid of that. But I think what will be weighing it down is the financing program. And then quite frankly, Cybertruck, how much progress did they make on COGS and Cybertruck? So that's, to me, the Tesla earnings piece. If you just had a 5-minute look into gross margins, it's pretty explainable what's happening. It's not structural. I think it's something that they can work through and resolve. On the macro side, the one thing I'll say is I will go back to this inventory piece. These auto companies getting over 90 days of inventory, they basically have the next quarter of product already built and already sitting in distribution for people to buy. Like they don't even need to build anymore. GM, for every 2 EVs they built in the first half of this year, only 1 was actually delivered. That'd be like Tesla building 800,000 cars in the first half and only delivering 400,000 over the first 6 months. That's the way they're running their businesses right now. So they're growing and ballooning inventory. So I do think there's a tie into that GDP number, which I think a lot of this was putting product into inventory. And that's where Matt's seeing the consumer slowdown. So that's auto's a little bit of a canary in the coal mine. I'd be a little bit concerned about that from a macro perspective.
Yeah. So that's looking back, the inventory restructuring, Cybertruck. What are your thoughts on capacity and that, what did they say, like 50% growth over 23?
It was the question that no analyst asked on the call that I was screaming about. I can't believe people aren't asking, why do you think you're going to increase your production by 50% next year? First off, when Tesla increases production, they aim to ship it. They run it 18 days of inventory. This isn't just to build stuff to have it. So we know they're ramping a couple of new products next year, but that doesn't speak to this big a jump. So there's something we don't know that's happening. We obviously know they're doing these new vehicles in the first half, but how much money can they actually take out of these vehicles? 4 to 6K? Do we really think that alone is going to drive the 50% uptake? Or is there something going on that's so special with FSD? And I've changed my decision in terms of, I always want to drive the car that has FSD on it right now. I almost would never want to get into a car, drive a car now. I don't know if if you think about FSD next year, It's just going to be would you buy a car that doesn't have FSD? I know we're all Tesla fans and so forth, but I think we know the answer to that, but I think others are going to know the answer to that. So why did Tesla increase production by 50%? It's not very clear. They don't do that willy-nilly too. They keep their production, their capacity tight. They basically have about a 20% buffer on the whole thing. And to say, hey, we're going to go from building 175 to 18, this year, and now we're going up 50% and we're putting in 3 million units of capacity. That's a big move. Nobody asked that question.
And then lastly, any chance, I know they don't want to Osborne, Elon is guiding for half of 25. Is there any chance that it comes earlier in your mind?
I don't think so. I
And
think
I wanna
these are the
say,
modules. Oh, sorry. I
Yeah.
was just going to say one quick thing. These are the modules from the next platform vehicle. These were going to ramp in the first half of next year anyway to support mid-year production of the next generation platform. I think there's some movement on that product. I don't know if it's a couple of months here or there, but Tesla, basically made a decision. We can build something that's lower cost using the existing CapEx and do it faster, get the market faster, get our COGS down faster, and leverage our existing CapEx longer. That is a much better decision to make when you're in an uncertain environment. Sorry, Alexander.
And I want to come back to what the discussion we had last week when Larry Goldberg was here and said he thought Robotaxi Day would only be later, like November or whatever, and could be up to January because it could be combined with the new models, right? Not only the Cybercab variants, but also new models. I think that's clearly no now because now we have Robotaxi event on October 10th. And I do believe the new models, and obviously Jeff knows much better than me, not on the unboxed model. So not on but on the mix of the current improved way of building, but not yet moving all the way to the future way of setup. I expect those in Q1 2025 now. I really think those are two segregated events, and we're going to hear very late about the introduction of these cars. And he said it twice. Osborne, and he said it a couple of weeks as well to Sawyer. Remember when there was this picture that was supposed to be a new Model Y? That disappeared very quickly because there was no new Model Y. I just think they're keeping it very clear. Nothing about new models for the moment. That's all 2025.
Wow. Okay, great conversation. Everybody's giving detailed information. Even you, Matt, thank you for joining on that. I appreciate it.
Even you, Matt. What does that mean?
Matt, come on.
Look, my reputation is going nerdy and deep on this stuff, so
You did great.
I don't know.
Oh,
you got to up your insult game, Herbert. It's got to make sense at least.
I'm not good.
To hang
I'm
out
not
with
good.
Farzad.
But I was listening very closely when Jeff was listening. That one I certainly was listening very closely to.
So he was listening closely to Jeff.
Jeff, yeah.
Matt, what the heck about you and me?
We've established that Jeff is way more interesting than I am. I've given my
Tell you.
Q2 recap to Herbert like 3 times, and he
Yeah.
still has no idea what I think.
No, we all agree. But Jeff, what you said was mic drop. Fantastic, Jeff. That was brilliant.